Yeah, so it's going to be challenging for markets with the Fed not just lifting interest rates, but also shrinking their balance sheets, so quantitative tightening. That's going to pressure the whole interest rate curve. So you're going to see cash rates moving up, but potentially the long end moving up as well as the Fed sells down bonds. So that's an environment where equity markets will potentially be pressured by higher bond yields and higher discount rates. And it's also an environment where you're going to see slowing economic growth as they tighten financial conditions. So downside cyclical leverage, so you want to be aware of companies that have maybe too much gearing, where their debt sits in terms of fixed or floating, their leverage to the economic cycle as well, and how much downside risk they have in those sort of environments. Yeah, so Jackson Hole, Jerome Powell, head of the Federal Reserve, made it very clear that their number one goal was to fight inflation. And the tricky thing there is you're not sure how far you've got to tighten rates, how much the economy needs to slow to actually make sure it's got it under control. And the only real reference point for the current economic climate is what happened in the 70s, where you had a similar environment of very tight labour markets through the late 60s going into it, an energy shock with OPEC in that case, and driving waves of inflation through the economy. And whilst they tightened and got things under control, inflation came back a few times, they eased again too early and inflation rebounded. And Jerome Powell was very clear that they're conscious of not easing too early, making sure they've got inflation under control and anchored it. And short-term pain is what is needed to provide the best term setup for longer-term recovery and growth. So they're quite clear that they're prepared to have a recession and potentially a deeper one to actually get those inflation dynamics stabilised and under control, and that prevents material risk for markets and earnings. So inflation's potentially already peaked, particularly around manufactured goods. So what we've seen, say, over the last 20 or 30 years is pretty steady inflation in non-tradable service areas, but really strong deflation around tradable goods. And a lot of that is driven by China, its emergence into the global trade, unlocking a lot of capital and labour and driving deflation in tradable goods. And that all changed with COVID and lockdowns. You saw supply chains tighten up, and around the world, tradable goods inflation surged, and that's helped drive the highest inflation levels in decades. So that impact on tradables inflation is now peaking out and it's starting to recede, but it might not go all the way back. We've still got some interruptions to supply chains. We've got big shift in geopolitics, and companies are changing the way they view the world. So they're looking to onshore more manufacturing, be closer to their consumer, get away from big integrated supply chains that are more at risk through periods of COVID disruption or geopolitics or anything like that. So that means that you've seen inflation peak in tradables, but it might not be the deflationary environment that we've had in the last 20 years. Meantime, you've got very tight labour markets, and that services non-tradable inflation has actually surged higher as well. And that's the real battle that central banks are fighting, getting that sticky non-tradable inflation down. And to do that, you really need to see a bit of slack back into labour markets, because that's all about cost push, higher wages pushing back into company cost bases, them raising prices and passing things forward. We see that broadly getting under control, but it's essentially going to be the blunt instrument of tighter monetary policy to create pain, to get companies to actually see an environment of lower profitability, lower demand, and start to shed labour and ease up some capacity in labour markets. So that's a little way off, and will create a lot of uncertainty and volatility in markets. So we're likely going to a period of higher stress for companies, so lower demand, higher financing costs, and there can be some complacency at times around balance sheets and leverage. So that's one clear area to be aware of. Companies that you're investing in, to what extent they've got leverage and sensitivity to higher interest costs on their business. And also, what sort of buffers do they have around changing demand? Do they have low margins, open to highly competitive industries where you're likely to see those margins eroded, less pricing power as economic growth turns down? So we're generally favouring companies that have got solid balance sheets, they're a little less economically sensitive. So maybe like healthcare companies with some good growth in niche markets with some good barriers to entry where they can control their margins and demand's not too impacted. So being aware of how those macroeconomic shifts can actually impact companies' earnings and risk profiles is important.